Welcome to the weekly market wrap-up. I'm Hannah Bernard. It was a tough week for Wall Street this week as indices blood red across the board, with biotech and social IPOs dragging down the NASDAQ and the Dow falling from its best day of the year to close 2% down on Thursday. Are we about to experience the classic correction analysts have been predicting? Let's get to it. After experiencing a phenomenal three-day rally, the Dow was slammed on Thursday, losing 1.6% in value to close at 16,170. But the Dow didn't get the worst of this week as the S&P 500 closed down more than 2% to 1,883. And finally, the ugly duckling of the week was the NASDAQ, closing down more than 3% of valuation on Thursday to 4,054. Which was the worst point drop since August 18, 2011. Now let's turn to Canadian markets. The Toronto Stock Exchange closed sharply on Thursday, continuing the trend from down south. The TSX Composite Index ended Thursday by dropping 127 points to 14,308, and the Toronto Venture Exchange dropped 9.81 points to close at 993. So is the correction already here? Well, that depends on the definition of a correction. A classic correction is when markets drop 10% or more, and we haven't seen that in over 2 years, and that's if you don't count a 9.9 drop in the spring of 2012. According to analysts, a classic correction is coming. 5 years into the bull market, analysts argue that for the past month, economic indicators have been flashing clear signs of a correction, and it is time to remove some exuberance and frothiness from the market. So what now? What can you do to ride out a correction if and when it comes? According to Jonathan Burton from MarketWatch, first, contain your emotions. This market is in a transition, and transitions are rarely smooth. You have to find ways to handle change more skillfully, not more easily, because change is always hard. Here are a few tips to help you adjust to the change. Act competently, composed, and with conviction. Investors can often be their worst enemy. To counter fear and greed, use self-control. Keep enough cash on hand so you're not dumping stocks at fire sale prices when pessimism is high. And finally, diversify your portfolio's risk to a level that is true and is honest. As a final point to remember, there's an old truism about investing. A stock doesn't know you own it and doesn't care whether you make money or not. Now to winners and losers and our picks for the week. The winner for this week is Rite Aid, ticker symbol RAD. Rite Aid shares surged this week after reporting fantastic financial results for the last quarter. The company was in the intensive care unit back in 2012 when shares plunged, leaving the stock to trade at about $1. Shareholders have been wondering whether the stock could make it off of life support and see it through, and well, it appears it has done that as the company is now delivering solid and consistent profits. Its shares are now trading at a healthy $7, up 39% for the year to date. Rite Aid has over 4,600 stores in the U.S., and they are the nation's third largest drugstore chain and the largest on the East Coast. And the loser for this week is Netflix Inc., ticker symbol NFLX. Shares in the popular company dropped over 5% this week, and many analysts are calling for the stock to drop to $100, losing 2/3 of its value. Netflix shares have been under pressure as analysts expect increased competition. In just the past week, Yahoo announced plans to ramp up its online programming, and Amazon unveiled its Fire TV streaming media device. It's expected that bidding wars for content will break out, seriously hurting Netflix. Well, those are our winners and losers for this week, and now it's time to check in on the gains you could have locked in by following the weekly watch list from Robert James and Viral Stocks. All right, that's enough about this week. Now let's turn to BayStreet.ca's look at the week ahead and the snapshot of what analysts are forecasting for companies whose earnings reports are coming out next week. US and Canadian markets are both closed next week for Good Friday, so we have a short week coming up. Here are 3 US stocks to watch. Starting off on Monday is Pep Boys, Manny Mo, and Jack with an EPS of 6 cents compared to a loss of 5 cents in the prior year quarter. Last fall, Pep Boys was cited by Equities.com as one of the up-and-comers in the fast-growing U.S. auto parts sector, given that when the economy goes south, car owners tend to hang on to their wheels a bit longer and need spare tires. Next up on Tuesday is Coca-Cola with an EPS estimate of 44 cents compared to 46 cents in the prior year quarter. Finally, on Wednesday is Google Inc. with an EPS estimate of $5.41 compared to $10 in the prior year quarter. Now checking in on Canadian stocks to watch next week. Starting off the week on Monday, we have Alderon Iron Ore Corp. With an EPS estimate for a loss of 4 cents compared to a loss of 5 cents in the prior year quarter. Earlier this month, Alderon commenced preliminary work for the Pointe Noire terminal facility in Quebec. This is the product handling facility for the Kami iron ore project, with mining and processing facilities located in Western Labrador. Also on Monday is SiriusXM Canada Holdings Inc. with an EPS estimate of 41 cents compared to 38 cents in the prior year quarter. And finishing up the week on Thursday is Post Media Network Canada Corp. With an EPS estimate for a loss of 25 cents compared to a loss of 21 cents in the prior year quarter. And that wraps it up. Thanks again so much for joining us for another weekly market wrap-up. Before you head out for the weekend, make sure to subscribe to our YouTube channel and find us on Facebook and on Twitter. For Viral Network News and BayStreet.ca, I'm Hannah Bernard.